So you're going to have to see home prices plunge, right? You're going to have to see the stock market plunge. You're talking about a depression from where the markets are now to where they should be. Home price to income ratios at an all-time record high, blowing away where they were in 2006, the previous high. Total market cap of equities to GDP, higher than any other time prior to 2020. You're talking about a massive crash. It's going to make every bank insolvent. So this is the conundrum. So we're either going to hyperinflate, stagflate, or we're going to have a depression. And that is the truth. I don't see any way around that. You could say, well, can I have a little bit of both? I don't think so. That's not the way markets work. They don't deflate gradually and gracefully.
On this episode of the What the Finance podcast, I have the pleasure of welcoming on Michael Pento, who's the president and founder of Pento Portfolio Strategies. So, Michael, thanks so much for coming on the podcast today.
Thanks for having me on, Anthony.
No problem. I'm looking forward to the conversation because I'm really interested in hearing your opinion about what we're currently seeing in the economy and markets. Because I guess if we look at the past year, everyone's thinking we're going to see a recession, and we probably still will. But the economy has been extremely strong. So, what are your current thoughts on what we're seeing?
It's a slow motion train wreck. And that's sort of displayed appropriately if you look at the averages. So, the Russell 2000's down, I think, 33% from its high that it posted at the end of 21. NASDAQ's down 13%, S&P's down 12%. So it's a bear market. And bear markets aren't linear. Lots of bear markets have huge bounces. I expect phase 2 of the bear market to commence very soon. We had the massively strong GDP print, 4.9%, according to the BEA. I think that's mostly just undercounting inflation. I mean, that's 4.9% real GDP. It's probably closer to 2 if you counted inflation correctly. But you see a lot of things underneath the surface are really eroding quickly. You see the leading economic indicators have been heading towards recession for a year and a half. That hasn't changed. The NFIB survey says recession. Inverted yield curve says recession. Delinquencies and defaults are rising. I have a bifurcated market. Most of it, I'd say the top 2 quintiles are doing fine. The 1%ers and a little bit below that. And then you have the bottom 3 quintiles that are broke, have no savings, less than $1,000 in the bank, and living paycheck to paycheck and getting killed by inflation. And then you also have the reverse wealth effect kicking in too. If you owned a bond, Anthony, if you owned a bond and it wasn't where we are, which is like really 0 to 3 years in duration, so the shortest end of the yield curve, get wiped out. If you owned extended duration bonds, you're down 60% in the past 2 years. And even if you just own 20-year plus, you're down 45. So it's been a train wreck. Everywhere you look has been a train wreck in the markets. There's been no place to hide. The only place to really hide is if you look at hide is maybe AI stocks, a couple, the Magnificent Seven, they call them. But even if you look at the NASDAQ, which includes the AI, the big parking place for all this wealth, they are down, as I said, 13% in the last 2 years. So there's over the last 2 years, which is the peak of the cycle, there's been no place to hide. On the other end of this, you're going to see economic gravity take hold. Money supply is shrinking. If you look at the lagged effects of 525 basis points of hiking, QT kicks into high gear in March when the reverse repo facility runs dry. So I think we're going to have a very, very tough 2024. And the way you survive that is by owning lots of cash, lots of treasury bonds, because now they have a place to rally from. When treasury bonds yielded 0, Anthony, the price couldn't really go much higher. I mean, it could only go down. Well, now you have a nice, juicy, fat yield, 5% almost across the entire yield curve. That yield can go back towards 2%. And I think you can make a lot of money in bonds. And then, of course, if you own the US dollar like we owned in the last 2 years, I think you'll do fine, you'll do fine in this next recession. You could not only not lose money, which is crucial when you invest, it's crucial not to take steep losses. 30, 40, 50% in the portfolio, like you did in 2000, 2008, 2020, 2022. So you have to preserve your principal, make some money in bear markets, and get ready and well positioned to make money on the other side of this bear market, which I think is going to be a very stagflationary exit.
Okay, thanks for running us through that. So if we sort of focus on where we currently are, and I guess you said 2024 is looking quite bad, what are the key indicators that you're going to be watching to sort of know when we start to roll over? Is there anything that you're really going to be paying attention to?
Well, so right now, Pento Portfolio Strategies has only two sort of if you include gold, 3 hedges. We have a little bit of physical gold. We have a small short in junk bonds, and we have an anti-beta ETF. So that's kind of our hedges that we have in place right now. I could throw in the US dollar there too, as I mentioned. But what I'm looking for to add shorts to the portfolio is I'm looking for 3 things to happen. I'm looking for a increase in initial jobless claims. And I'm not going to give you the exact data points, but I have them in my mind. It's math. It's all based on math and rate of change differences. When I see a trigger there, that's going to make me want to short the market. Just take on straight shorts in the market. I want to see financial conditions begin to tighten. So far, they've actually been loosening over the past few months. I want to see those financial conditions begin to tighten. And lastly, I would like to see high yield spreads to treasuries start to blow out a little more than they are now, which is like 4.37%, which is not, it doesn't flash a warning sign. When those 3 things happen, and those are all things that are major components of my 20-point model, when those things happen, I'm not going to give you the proprietary methodology I use to score them, but I will tell you what I'm looking at. And when those things happen, I know that the next phase of the bear market has arrived and is going to get much worse, going to intensify rapidly. And that's when I'll adding shorts to the portfolio. Don't forget, when you short stocks, it's a very dangerous game. It's very hard to be right. It's very expensive. And you got to do it correctly. So you have to be in and out of these shorts. You have to get the timing right. And that's what I'm going to do.
Okay, makes sense. And yeah, without maybe giving us away all the secrets, as you said, if we look at the market conditions, you're saying sort of it's quite loose at the moment, it's not very tight. What would, I guess, show you that markets are a bit tighter than they currently are?
Well, like I just said, I look for financial conditions to tighten. I want to see initial claims jump, continuing claims jump, and I want to see high yield spreads widen. If that doesn't happen, then I'm not going to force the market. I'm not going to force the market to do something it's not ready to do, and that's how you lose a lot of money. So when the economy is ready to go over the cliff, I'll know, and I'll get out. Well, everybody else is saying, "Oh, it's an aberration." Consumer is strong. Don't bet against the American consumer. Consumers are flush with cash. Businesses have deleveraged. Public debt doesn't matter. Blah blah. I mean, I can go on and on with all the platitudes that you'll hear from the permabulls who are paid to say things to get the market go up, because that's what they do. They sell bonds, corporate bonds, and they do IPOs, and they make money when the market is bullish. I don't do that. I mean, I make money both ways, long and short the market, currencies, commodities, equities, international, whatever, wherever I think my money and my clients' money is going to be treated best. That's where I go.
Yeah, makes sense. So you mentioned that you think we could get into a stagflationary period sort of after the recession or even during the recession.
Well, here's the problem.
Yeah.
Sorry to cut you off. Go ahead.
No, you go. It's all right.
I don't want to talk too much. I gotta let you have a question.
That's.
I apologize. I have a habit of doing that. So you just tell me, stop. I gotta finish my question. Listen, we have since 1987. It's been a very easy playbook. After Volcker vanquished inflation, took inflation down from 20% down to low single digits. The playbook has been, hey, if there's a bear market or a recession, we have a tool. It's called the fiat currency. We're going to just print the heck out of it. That's been the playbook from the Federal Reserve, and now the Treasury came on board in 2020 post-COVID. That's easy to do when inflation is quiescent or below the Fed's asinine 2% target, as if the economy can't function with a 1.5% inflation rate. We could talk about that if you wanted to. But when the inflation goes from below 2% for many, many years and then goes to 9%, and that's the way the BLS measures it, the Labor Department. If you measured it accurately, it's closer to 20%. Then you got an inflation problem. In other words, the market is losing faith in your ability to provide a real return for investors to vanquish inflation. So then you have a problem where you say on the other end of this, if we have a recession and deficits go from $2 trillion per annum, which they were in fiscal 23, to $6 trillion, the automatic stabilizers kick in, deficits go to the roof, right? Revenue contracts violently because people are no longer working. They're not paying income taxes any longer. You blow a hole in the deficits. Usually, it doubles, triples. So you go from, $2 trillion to $6 trillion. That's going to be the deficit. And then the interest on that deficit and debt, which is now we're at what are we now? $33.5 trillion in national debt. The interest is $720 billion a year. That's going to, just because interest rates went from 2.5% average interest rate to, I said 1.5 to 3, we're going to be paying an extra $800 billion. So we're talking about $1.5 trillion in interest payments per annum. Well, you got a problem if you're the Federal Reserve. If you're the Federal Reserve and your playbook now says, I am now going to paper over all this recession and the bear market by just flooding the market with money, the banking system with reserves. I'm going to lower interest rates, and the Treasury is going to do another round of helicopter money. Well, I mean, who's going to be fooled? What investor is going to be duped into thinking that the Fed or the Treasury is going to allow markets to function freely and allow interest rates to rise to a level that provides a real interest rate? Nobody's going to be fooled anymore. We just have too much debt, and asset bubbles are so humongous that the Fed has to come in and to engage in interest rate repression. And I don't think inflation is going to go from where it is now, almost 4%, back to 9%. I think it goes to 19 and then goes higher from there. That's a very real risk if that's the playbook from the Fed. Now they might not do it, Anthony. They might not do that. They might say, because that's what they're talking tough right now. They might say, we can't do this anymore. We can no longer engage in this policy of ZERP and endless QE. Can't do it anymore. And then you have to allow the natural gravitational forces of macroeconomics is a catharsis. So you're going to have to see home prices plunge, right? You're going to have to see the stock market plunge. You're talking about a depression from where the markets are now to where they should be. Home price to income ratios at an all-time record high, blowing away where they were in 2006, the previous high. Total market cap of equities to GDP, higher than any other time prior to 2020. You're talking about a massive crash. It's going to make every bank insolvent. So this is the conundrum. So we're either going to hyperinflate, stagflate, or we're going to have a depression. And that is the truth. I don't see any way around that. You could say, well, can I have a little bit of both? I don't think so. That's not the way markets work. They don't deflate gradually and gracefully. So this is the dilemma. It's not my dilemma. I'm just going to invest around it. It's a dilemma of those people that did this to us, the perpetrators, which are the Treasury and the Fed, which is supposed to be there's supposed to be a wall between those two people. I think, you remember the former head of the Fed was Janet Yellen. So these two people can work hand in hand. They've done so in the past. And I believe if you ask me, you say, Michael, I need you to guess what's going to happen. The answer would be, I believe that Powell will have no choice but to reliquefy the banking system, because the depression is going to be so deep, so trenchant, so cutting, so pernicious that he'll have no choice.
Okay, thanks. I feel like you read my mind because my question was going to be in a recession. Would we see the traditional phase of inflation going down, potentially deflation? But it sounds like you're saying it's probably not going to happen this time because of these other factors that you mentioned.
Well, it'll be a truncated period of recession and asset price correction. Once it gets to the point where the money markets stop to function, if you can't float commercial paper, the repo market blows up. High yield spreads blow out to the point you can't issue any junk debt. Well, then the Fed has no choice. I mean, they have to do something. This is a fiat currency economy. It's a debt-based monetary system. If you can't float commercial paper, the economy shuts down. It shuts down. So you can just lay off every employee, and the stock market's not going to go down 10%. It'll go down 80%. So it can't happen. Home prices aren't going to go back to where they were pre-COVID. I mean, they're going to go down 50, 60%. And then every mortgage-backed security on the planet is going to be, they'll be insolvent. So they have no choice but to do. This is the result of this is a result of taking interest rates to near 0% for really 11 of the last 15 years, near 0%. I mean, think about it. Think about when you do that, what happens? You're encouraging people to say, oh, money's free. And this is not a US problem, by the way, Anthony. This is a global problem. There's a global problem. There was $17 trillion worth of negative yielding debt. People were getting paid to borrow money. Talk about the misallocation of capital and the bastardization of market signals that you engender when you get paid to go into debt. This is what they've done. I mean, Japan is a train wreck. Europe is a train wreck. China is a train wreck. All the big economies on the planet are train wrecks. And that includes the United States.
Yeah, that links quite well to my next question. I was going to say, what does this mean for the dollar? Because as you said, if they sort of coming in, it seems like it's going to be yield control. There's going to be just all this debt going around. Do you see the dollar continuing to have a strength? Will it still be the world currency, or is it just the fact that all other currencies continue, depreciate as well because they're doing the same thing?
Well, when you ask me about the dollar, we've owned it for 2 years. It's been very beneficial for our clients. And I'm someone who thinks the dollar is losing its hegemony in the world, its world reserve currency status. I get that. I understand that. Other countries no longer want to have that ability of the United States to cut them off of their reserves and destroying their economy. So I get it. But when you ask about the dollar, you have to say a dollar against what? So it's a currency pair, right? You're talking about a pair. So will the dollar lose its value against gold? Absolutely, in my opinion. Will the dollar lose its value against the euro? I don't know. I mean, I don't think so. I still don't think so. Not at this point. At some time in the future, it will. Simply because when I look at currency pairs, I look at interest rate differentials and growth differentials. Well, when the U.S. hits a recession, which I believe will happen in 24, I thought it would happen by now. In all honesty, it's just that the government was spending a tremendous amount of money. The excess savings took longer to deplete. I thought it would happen by the end of this year, and I probably am going to be wrong. Not wrong in the portfolio construction because I don't. If I predicted a year ago we'd be in recession at the end of this year, that doesn't mean I don't change the portfolio allocation. It means I made a prediction and you're delayed for a couple of months, a couple of quarters. But I think in 24 and next year, we will definitely have that recession, long delayed recession. And then I think, so you have the growth rate will match that of Europe more. And then rates start coming down, if I'm correct about that. Then there's going to be no difference between that of the euro and that of the dollar. And then there's a lot of ground to make up there. So I think the dollar could plunge next year against the euro. But that's after the recession becomes manifest. The first impulse would be to go to the dollar because of global chaos, and then the second impulse will be get out of the dollar as the rates start to tumble towards that of where the ECB is.
Yeah, okay, that makes sense. And you mentioned previously that you think bonds could potentially, I guess, perform in the short term from where they are now. Do you see a sort of a similar trend to what we've seen in the last 40 years, where um, equities and bonds are sort of reverse correlated, so one goes up, one goes down? Because I guess if you look at the past 2 years, it's they've been correlated.
So in 2022, when the average portfolio was down 20%, equity portfolio, you look at the 60-40 portfolio and you say, well, I would hope that the bonds would offer, would offset that. That would be a ballast to the portfolio. As I mentioned before, bonds weren't a ballast. They exacerbated. It was pro-cyclical there. They just exacerbated the drubbing that you took in equities. So I think at this point, the AG, which is the investment grade bond index, is down 23% from its high. That includes all investment grade bonds. But as you go out along the yield curve, that drubbing could have been 60%. You look at extended duration. But that's what happens when yields are zero and the bond market is ripe for a collapse. I think and the next time we have a recession, which is 2024 on the schedule, you'll see stocks fall, but bonds will give you a ballast because they have that level of safety now. You can't rally interest rates lower from virtually zero. There's just not much room to go. But from 5%, there's a lot of room to run there. So yes, they will offer a ballast, but you got to be careful now because there'll be a truncated period of time that you can invest in duration, in my opinion. Because once the Fed starts to reliquify the money markets, then you're going to have a problem with duration. You're going to have a supply problem and you're going to have an inflation problem. So I think the long run yields are going much, much higher than they are today. But you will have that little short period of time when equity prices collapse, recession metastasizes across the globe, people rush into the dollar and U.S. Treasury market for safety, but it's not going to be as intense as it used to be. And it won't last that long because everybody knows the playbook now. What's going to happen? Everybody knows. And the U.S. is heading towards insolvency if it's not insolvent already. I think it's insolvent already. Listen, Anthony, let's just give you some facts. The U.S. is adding to so the U.S. has revenue each year. The U.S. government has revenue each year. It's about $4.7 trillion. We're adding to the national debt, which is $33.5 trillion. We're adding 45% of our revenue to the debt. So the deficits are adding to the debt every year. And the deficits equal 45% of our revenue. And the debt is 771%. The debt of our income. So if you went to a bank and you said to the bank, okay, so you're making $100,000 a year, just pick a number. I make $100,000 a year. I'm adding $45,000 to my debt pile every year. And my debt is $771,000. The bank would throw you out right on your butt. That you want a loan? You want me to give you a loan? And you are insolvent. You have an untenable amount of debt compared to your revenue. And you have, you're adding to that debt equal to almost half of your income every year. You're done. And if they were so stupid to give you a loan, it would be a loan that was 50% interest rate because the risk is too great. That's where we are as a country. And that's in the good time. We're not now officially in a war any longer, and we are in peacetime, and we are in a time of full employment, supposedly, and with 5% GDP growth. Just imagine how bad those numbers I just gave you are going to be in the recession. And the recessions are coming. They haven't been canceled.
Is there anything they can do to avoid the recession or to change the current trajectory of where we're going?
I listen, there's not, how do you, in other words, is there a painful, perfect dismount, a perfect landing? No, it's a crash landing. To me, as a crash landing is virtually guaranteed. How you crash the economy is important, because if you crash the economy appropriately, which would be I call it a grand reconciliation of asset prices. You listen, asset prices have no business. So home prices, for example, have no business being 7.5 times your income. Just unsustainable. It just unaffordable. You've locked out first-time home buyers. So if home prices are unaffordable, what's the resolution? Well, you could bring interest rates down to zero, but that's not really going to help you in the long run, because when interest rates are zero, people just pile in. Everybody bought 5 houses post the pandemic, and they did the same thing in the aughts. So the real solution is to let the market forces work to cleanse, a cathartic purging of these excesses. Bonds we shouldn't have $17 trillion of negative yielding debt. Bonds should be offering 1 or 2 percentage points above inflation. So, 5%, 6%. Bond sounds right to me. Should never go back to zero ever again. The Fed's balance sheet should never have gone from $4.5 trillion pre-pandemic to $9 trillion. It's a massive deformation of markets. The stock market should never be 100, was at the high 200% of GDP in the start of 2022. The stock market should be more like 70% the valuation of stocks as compared to GDP. So if you let the market function, and as slowly and carefully as you bring those assets back into reconciliation with the free market, then you'll have a lasting recovery on the other end. In other words, I think the best thing for us is to have a very deep, trenchant, sharp depression, wring out all the excesses, stop the bull crap with the interest rate manipulation, let markets function, and then we'll have a real economy on the other side of this. If we don't do that, and I highly doubt that's going to happen, we're going to relive these boom bust cycles over and over again, and they will grow more intense over time.
Yeah, and I can imagine they'll be amplified by all the external things that are happening around the world as well, with the conflicts and other factors.
Correct.
Yeah, makes sense. So if that were to happen, then what assets would you be? I'm assuming sort of precious metals, and you mentioned homes aren't going to perform, but what other assets do you think would protect wealth during that period?
During the period of what? The grand reconciliation of asset prices?
Yeah, so even just recession.
Yeah, well, so cash always is important. Treasuries, not junk bonds. So you don't just buy bonds, you buy U.S. treasuries. They have traditionally worked well. The U.S. dollar has traditionally worked very well in a global chaos and recessions. And of course, you have to be able to short the market appropriately too. So like I talked about before, so you want to be in and out of these shorts. I manage money for retirees, excuse me. So we can't short the market. We use ETFs that go long. We use ETFs. We go long the ETF that shorts the market for us. We also use inverse ETFs. We go long inverse ETFs. But these things can't be bought and held for a long time, though. They have to be appropriately managed. So if you see a big downward slope in the economy and the markets, you might cover some, and then on a bounce, you can re-short them or buy them again.
And why can't you hold them for long time? So,
well, it's the way the math on inverse ETFs is terrible. So, I don't want to go through the whole math right now on the interview, but because of the way the math works, you're getting an increase off of a lower percentage. So let's, like, for example, suppose you shorted the market, and the market went up 50%. Okay, you'd be down 50%. Well, now you have to make 100% to be even. And it's just the volatility in these ETFs work against you, especially if you go into leverage. We don't use leverage, a 2, 3, 4 times. That's just ridiculous. But if you have an inverse ETF, you can hold it for a few weeks and months, and that volatility will not hurt you that much as long as it's linear and you don't hold it for a long duration. But if it gets very choppy and you hold it for a long duration, you're just not going to make any money. Even though you could be right on the direction, you'll be wrong on the ETF. So you have to choose the ETF that you use to go long carefully. And you have to monitor that trade assiduously.
Yep. Okay. Makes sense. So Michael, thanks again for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
I think active management is something that is always poo-pooed by Wall Street. I call it the deep state of Wall Street. They would love you to buy a 60-40 portfolio, buy and hold, dollar cost average, time in the market, not timing the market, blah, blah, blah. If you have a good model, you can identify these recessions. And recessions are essential to identify, and bear markets are essential to identify, because the market has a habit of going down 30, 40, 50% in these cycles, these bear cycles. And if you can accurately measure that and participate in bull markets and avoid getting crushed in bear markets, that is the best way you can manage your retirement. And the reason why I would say it's more essential now than ever, say back in maybe 1960s, it wasn't necessary to do that, because asset prices were generally fair valued, much more fair value than they are today. So you had choppy markets, but for the most part, being long the market was the way to go. But if you look back in the last 20 years or so, it's just not the case. These bear market traps are vicious, and they're coming with greater intensity, and shorter durations between these collapses. So it pays to have a good model that measures and maps and identifies the second derivative, the rate of change of inflation and growth, the way we do. And if you can do that, you can hopefully, the goal is to not lose, but to hopefully make money in bear markets, and then identify when the bear market ends so you can go long and buy and hold like everybody else.
Okay, makes sense. So, yep. Thanks again for your time today. I really appreciate it. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
So it's pentoport.com is the website. I have a free 5-week trial for something called the midweek reality check. Gives you my thoughts, 36,000 feet in the air about the economy and markets. If you have $100,000 to invest and you're a U.S. citizen, I will directly manage the money for you. I use Charles Schwab as a clearing firm. We don't charge huge fees. You have complete access to your portfolio. So it's very non-opaque friendly. It's very market friendly. It's not like traditional Wall Street. And the ability to go from, long to short to high levels of cash to the right side of the yield curve is becoming more and more crucial. And that fact is proven over and over again. And if you look past, like in the last 20 years, it's going to be even more evident as we go through time.
Yep, I definitely agree. So, Michael, thanks again for your time.
You're welcome, Anthony.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.